Fed rate cuts. What it means for your money. The Federal Reserve just met, and their decision will either save you thousands on your debt or cost you money in your savings account. This is the most critical financial news you need to understand right now. We are talking about the macroeconomy directly impacting your credit score and your monthly mortgage payment. Are you ready to make the right moves? Right moves? The financial world is fixated on the Federal Reserve's interest rate decisions, and for good reason. When the Fed moves, your wallet moves. Their goal is price stability and maximum employment. To achieve this, the Federal Open Market Committee, or FOMC, adjusts the federal funds rate, the benchmark rate banks use to lend to each other overnight. This single decision creates a powerful ripple effect that touches every single financial product you use every day. We are currently in a period where the Fed is widely expected to continue cutting rates, or easing, after a long period of holding them high to combat inflation. But what does this actually mean for the average consumer? Is a rate cut always good news? The answer is nuanced. It is great for borrowers, but tough on savers. We are going to break down exactly where you win and where you lose, and how to position your money strategically. First, let us clarify the mechanism. The Fed does not directly set consumer rates for mortgages or credit cards. Instead, they influence the short-term cost of money for banks. When the Fed cuts its benchmark rate, it reduces the bank's cost of borrowing. This lower cost gradually trickles down, creating downward pressure across the entire financial system. Understanding this lag time is key to successful financial planning. Let us start with the area where you gain the most: borrowing, credit card debt, and HELOCs. This is the most direct and immediate benefit for borrowers. Credit card interest rates and home equity lines of credit, or HELOCs, are typically tied to the prime rate, which moves directly in step with the federal funds rate. As the Fed cuts rates, you should see a corresponding, albeit slight, decrease in the annual percentage rate, or APR, on your revolving credit balances. If you are carrying a large credit card balance, this is the time to consolidate or use a 0% interest balance transfer offer before rates start to stabilize. Even a quarter-point cut can translate into significant savings over the life of your debt. Auto loans and personal loans. The rates on new auto loans and unsecured personal loans are also directly influenced by the Fed. While a single 25 basis point cut may not dramatically slash your monthly payment, the expectation of further cuts in 2026 creates an environment of greater affordability. If you are planning a large purchase, such as a new car, lower expected rates can increase your purchasing power and make that purchase a better financial decision. This increased affordability across the nation also serves the Fed's purpose of stimulating economic growth. Now, let us tackle the biggest and most complex item: mortgages and housing. The common misconception is that when the Fed cuts rates, the fixed 30-year mortgage rate drops immediately by the same amount. This is false. Fixed mortgage rates are long-term loans, and they are primarily tied to the yield on the 10-year Treasury bond, which reflects the market's long-term expectation for inflation and growth, not short-term bank borrowing costs. However, repeated rate cuts over time, especially when paired with softening inflation data, tend to create a favorable environment. The market anticipation of Fed easing often pushes Treasury yields down before the Fed even acts. This is why we have seen fixed mortgage rates recently trending lower. For prospective home buyers, this is a golden opportunity to lock in a rate that makes homeownership more accessible. Adjustable rate mortgages, or ARMs. If you have an adjustable rate mortgage, your payments will likely decrease more directly. ARM rates are often tied to short-term benchmarks which move in closer correlation with the Fed 8S rate decisions. Homeowners with ARMs will feel the relief sooner. Refinancing opportunities. For current homeowners, a period of sustained rate cuts is the ideal time to explore refinancing, especially if your current mortgage rate is still above 6.5%. Refinancing can drastically reduce your monthly payment, freeing up capital for other investments. Now, we must address the trade-off: the pain for savers. For every borrower who saves money, there is a saver who earns less. This is the flip side of the Fed's policy. When the central bank cuts rates to encourage spending, it simultaneously discourages saving. Banks and financial institutions typically lower the rates they offer on certificates of deposit, or CDs, money market accounts, and high-yield savings accounts. If you have been enjoying high annual percentage yields, or APYs, on your high-yield accounts, expect those yields to gradually decrease over the coming months. While the yields will likely remain significantly higher than traditional brick-and-mortar bank accounts, they will drop. The best strategy for savers right now is to shop around and lock in high rates on longer-term CDs before those rates fall further. Delaying gratification by locking up money for 12 to 18 months can maximize your return before the full impact of the rate cuts is felt. The overall context of Fed cuts signals a strategic pivot. The central bank believes the risk of a weakening labor market and a slowing economy now outweighs the immediate threat of slightly elevated inflation. They are prioritizing job protection, but this stimulus comes with the necessary trade-off of lower returns on cash savings. For the prepared consumer, this environment is a strong motivator to move cash from low-yielding savings and put it to work in higher-growth assets. The key takeaway is that the impact of the Fed's move is not uniform. It is a signal to act strategically. Be proactive about your debt by refinancing or consolidating, and be strategic about your savings by locking in the best possible CD rates now. Do not let these critical financial decisions be made for you. Take control. If you found this detailed financial analysis helpful and want more strategies to protect and grow your wealth, please leave a like and subscribe to the channel. The goal is always to get you more money. See you next time.